Welcome back. This is chapter 3, video 8. And this video will be about the classified balance sheet. So let me share my screen. Okay. Okay. Explain and prepare a classified balance sheet. What we're going to do is we're going to provide more information inside our balance sheet. And what is this new information? Well, we're just going to categorize our assets and liabilities into current and non-current. Current meaning short term, and non-current meaning, well, I'll just say over a year. So when I say a current asset, those are assets that will be used up or converted to cash within 1 year. And on the current liability side, current liability would be something that we're going to have to pay within 1 year. Now, the true definition, the more comprehensive definition, is current items are expected to become due or collected or owed within the longer of 1 year or the company's normal operating cycle. Okay, so I've been a CPA for decades now, and I've never seen anyone that has an operating cycle over a year. So basically, all you guys have to remember is the 1 year mark. I can give you an example of a company that where the operating cycle is more than a year. A good example would be like high-rise building contractor, and it may take 2 or 3 years to build a high-rise building. So their operating cycle may be over than a year, yeah. So, but for our purposes, the 1 year mark is fine. So here are our current assets. We start out with cash because, we're talking about assets that are going to be used up or consumed or converted to cash within 1 year. Well, cash is cash, so it's listed first. And then we go to accounts receivable. Why? Well, accounts receivable, usually we collect that in 30 days. And then it goes all the way down to prepaid insurance. Now, those are our current assets. Then we have our long-term assets, those that are going to last us over a year. And we're going to talk about each of them, long-term investments, plant assets, and intangible assets. Plant assets are kind of easy to remember, and so I'm going to use that as an illustration. When we buy a truck, we're going to put it under plant assets and equipment, and it's in the long-term section because we're going to drive that truck for several years, right? So that's why it's in the long-term section and not in the current section. All right, and then we have liabilities, current liabilities, and then long-term liabilities. Well, we start out with accounts payable because we're going to be paying these amounts within 1 year, right? Anything that we're going to have to pay within a year, we put it as a current liability. Well, wages payable would be a current liability. Can you imagine? You tell your employees, well, yeah, you work for me, but I'm going to pay you over a year from now. No, they're not going to like that. So we know that wages payable is current. In other words, we're going to pay it within a year. Now, the long-term liabilities would include like mortgages payable, that maybe like my house loan. When I first took it out, it was a 30-year loan. So definitely it would be in the long-term section. Okay. Here we have a notes payable that's due in 10 years. So that's not current. It's going to be in the long-term section. And then equity is not going to change in our classified balance sheet. We're still going to have common stock and retained earnings. Those are the two components of our equity. Okay. So let's go ahead and just take a look at each of these sections. I was saying that current assets are expected to be sold, collected, or used within 1 year or the company's operating cycle. I told you that, hey, just forget about the operating cycle. You know, if you can remember that current assets will be used up or converted to cash within 1 year, that's all you need to remember. Okay. Here's some examples of current assets. Like I was telling you, cash is cash, so it's listed first. And then you have short-term investments. Those are investments in stocks and things that you're thinking about, selling within a year. Your accounts receivable, your inventories, and your prepaid expenses like prepaid insurance and prepaid rent, all that, those type of things. Inventory would be current because you want inventory to move. If you bought inventory to resell to your customers and you have it still in your store over a year from now, well, you bought the wrong inventory or you bought too much of it or something. So anyway, inventories are meant to move within 1 year. So inventory would be current asset. Now it's interesting to note that current assets, or all assets actually, are listed in order of liquidity. Ooh, that sounds difficult, doesn't it? Well, liquidity is just the ability to convert it to cash, right? So that's why cash is listed first, because cash is cash. It doesn't even have to be converted, so it's always listed first. Okay, those are current assets. Let's now go on to our long-term assets, which would include long-term investments. Those are investments that we're going to be holding for more than a year. Okay, so let's say we buy investments in stocks and bonds of other companies, and we're going to hold on to those for more than a year. Then that would be in the long-term section. Also, we could buy land or buildings on spec, right? And so we're going to buy them, and we may sell them, years down the road, but we're not going to sell them within a year. So it's going to be the long-term section. The next section is plant assets. And sometimes we call plant assets property, plant, and equipment. Matter of fact, if you got hip to the lingo, if I'm your boss, I could say, hey, go get me the PP&E schedule. And you'd bring me back the property, plant, and equipment schedule. Property meaning land, plant meaning the building, and of course, equipment is equipment, right? Now, plant assets are tangible, long-lived assets. What do I mean by tangible? You can touch them. You can touch your truck, right? It has physical substance. You can touch your computer monitor. That would be a plant asset too, right? Okay. Notice here that we have our PP&E here listed: land, buildings, equipment, and then we have this thing called less accumulated appreciation, right? So remember, accumulated appreciation is a contra asset account. It does show up on the balance sheet, right? It shows up on the balance sheet. So remember, accumulated depreciation is an asset. It's a contra asset, and it's going to go against our assets. Okay. The next one is intangible assets. Now, what do I mean by intangible? You can't touch them. They lack physical form. So what would be a really good example of an intangible asset? I own an intangible asset. I'm a songwriter, and I have a copyright on all my songs, right? So if an artist wants to record my song, they're going to have to make an arrangement with me and pay me royalties. Why? Because it's my song and I own the copyright. Now, you can't really touch that copyright, but it's there and it has value. Another one I think is really kind of cool is this phrase that Pat Riley of the LA Lakers copy wrote. He called it three-peat. I don't know if you guys recall when Michael Jordan was playing for the Bulls, they were going for their third championship, right? And Pat Riley said, wow, if they win that third championship, that's a three-peat. So he copyrighted that word. And when Michael Jordan and the Bulls won that championship, then they started making these T-shirts saying three-peat. And every time that a T-shirt was sold, cha-ching, Pat Riley of the Lakers, who copyrighted that phrase, got money. And so that copyright was intangible, yet it had value and it made Pat Riley a lot of money. Okay, let's just try to prepare the asset section of Hoffman Company's balance sheet. So we're going to start out with current assets, and we're going to list them in order of liquidity, which means the ability to convert to cash. So, well, cash is cash, so I'm going to start out with cash, right? The next one, well, we only have two left. We've got accounts receivable and inventory. Well, I know that accounts receivable is going to be used up and converted to cash within 30 days. So I think that's going to be next. Okay. Then finally, well, we got inventory, we got prepaid insurance. I'm going to go with inventory. And then finally, prepaid insurance. It's that prepaid insurance is always going to be in the current asset section. Matter of fact, the FASB says that even if the insurance policy is good for over a year, you still put prepaid insurance in the current section. So we'll put it there. So we have total current assets of 7,600, right? We have all of our current assets. Next, we need our long-term assets. And you know, the only long-term asset I see is my plant asset equipment. And it's related accumulated depreciation. So let's go ahead and take equipment and put it in. And we have to subtract its related accumulated depreciation of 2,700. So this is what we call book value, right? 10,700 for equipment less the accumulated depreciation means the equipment has a book value of 8,000. So what's my total assets? Well, my current assets and then my long-term assets, my plant assets, add up to 15,600. Okay, let's move to current liabilities. Current liabilities are obligations due within 1 year. And, you know, I always say, or the company's operating cycle. Yeah. But for you, just remember, due within 1 year. Okay, that's what you got to hang on to. If I see you at River Park and, hey, what's the current liability? Those are amounts that are due within 1 year. That's all you need to say. And if you can't remember it, you better run fast. And I'm getting slow nowadays, so you can definitely outrun me. All right. Anyway, our current liabilities would include notes payable, accounts payable. Now, these notes payable that are here will be due within 1 year. Now, you'll notice that you can have long-term liabilities, but those notes will be due over a year from now. Maybe it could be like 30 years from now, right? Okay, then you have accounts payable. This one is interesting. Current maturities of long-term debt. I remember having to figure this one out as a young CPA. My job as an auditor was to go through all of the notes of my client and to see how much they're going to have to pay within the current year. So they had all of these long-term notes, but some of them, some of them were going to have to be paid at least partially within the coming year. So then we had to reclassify that long-term debt to current maturities of long-term debt, right? These are the amounts of the long-term debt that are going to be paid within 1 year, okay? And the others you don't have to worry about too much. Okay. Now, long-term liabilities, they're obligations that are not due within 1 year, right? They're not due. They're going to be due over a year from now. And just for now, just remember, it'd be like long-term debt. These are like deferred income taxes. That's beyond the scope of our textbook here. It does go here, but you don't have to know about it. Just remember, these are obligations that will not have to be paid during the next year. And then finally, we have this equity. And as we know, equity is the owner's claims on the assets. And owner's equity is made up of two components: common stock and retained earnings. Okay. All right. Let's test how you're doing here. The following accounts were taken from the financial statements of Callahan Company. Now you've got to tell me where that each of these would be found on a classified balance sheet, right? And if they're not on the balance sheet, just put NA. So is it current assets, current liabilities, long-term investments, property, plant, equipment, intangible asset, long-term liabilities, stockholders' equity? Oh man, that's a lot. Okay. Salaries and wages payable. Do you think your employees are going to wait for over a year from now to get paid? No, they're definitely going to be paid within 1 year. So that's going to be current liabilities. How about service revenue? Hopefully you'll say not applicable. Revenue belongs on the income statement. That's a sucker's move right there. They're trying to get you, right? They're putting out the line and they're fishing. And like I say, you know what they're fishing for, right? Suckers. So anyway, service revenue is on the income statement. It's not on the balance sheet. How about interest payable? Well, that's going to be, a current liability as well. You're going to have to pay that within a year. Goodwill. Now, that was listed as an intangible asset. And so I'll just give that one to you because we're going kind of fast here. So it's intangible. What is goodwill? Well, you record goodwill when you buy a company. So let's say the fair market value of the assets that you're buying are $1 million, but you're willing to pay $1.5 million for the company. Well, if the assets are only worth $1 million and you're willing to pay $1.5 million, why? Because of goodwill. It could be a good reputation, a good customer base, a great employees, those type of things. And so anything over the fair market value of the assets is what we call it's intangible. We call it goodwill. So goodwill is an intangible asset. How about short-term investments? Well, when you think short-term, you're thinking current, right? And it's an investment. You own it, right? So it's going to be a current asset. Mortgage payable, due in 3 years. Hey, it's a payable that's going to have to be paid over a year from now. Well, then that's going to be a long-term liability, right? Now, this one, I think I'm just going to give it to you because in today's world, who knows? Investment in real estate, they call it a long-term investment. I have a nephew and he buys real estate and he flips it. It's fast. He's trying to make a fast buck, and he's done pretty well at it. So, it can be investment in the real estate can be short term, but we're assuming that you're going to hold on to it for over a year. So in this case, it'd be a long-term investment. How about equipment? Well, that's property, plant, and equipment, right? That's the asset. Equipment is property, plant, and equipment. Or sometimes we call that plant assets, and they'll even call it fixed assets. Okay, how about accumulated depreciation equipment? What in the heck is that? Where does that go? It's still an asset. Yeah, it's a contra asset, but it's still an asset. It's going to show up in the plant asset section, or the PP&E section, right under the equipment. It's a contra account to the equipment. So I know it's weird. Accumulated depreciation has a credit balance while assets have a debit, but we still consider accumulated depreciation an asset. It's a contra asset, but still an asset. Okay, how about the depreciation expense? They're trying to fish. Don't fall for it. Expense goes on the income statement, so it's NA. How about common stock? That's pretty easy. That'd be stockholders' equity. How about this one? Unearned service revenue. This one messed me up as a student. What would that be? Unearned service revenue. How many say it goes on the income statement because it's a revenue? See, when I was starting out, I hung on to that word revenue. Remember, I told you, hang on the word unearned. If you hear payable or unearned, it's going to be a liability. So unearned service revenue is going to be a current liability. Okay. Good. What we're going to do now is prepare a classified balance sheet. And we're going to use exercise 3-22 on page 129. Now, I put this on PowerPoint, so you just look here and enjoy the show, but you get to see how we put it together. Okay, so here is Wilson Trucking Company trial balance, December 31. And we're going to use this trial balance to prepare our classified balance sheet. Okay, so what do we do? What are the categories? Well, first we're going to have total assets, and we're going to have total liabilities and equity, right? Total assets equals total liabilities and equity, right? And under assets, we're going to have current assets, and well, spoiler alert, we're only going to have one non-current asset. It's going to be trucks. So it's going to be over here under plant assets, right? Next, we have liabilities. And again, we're going to have current liabilities, and we'll have long-term liabilities. And then finally, we have equity, right? Here we go. So let's start out building our current asset section. We'll start out with cash of 8,000. It's going to be cool. We're going to go right down the road. Accounts receivable. It's going to be converted within 30 days. That's going to be next, I believe. Yes. 17,500. Then we got office supplies. Well, if you don't use those up within a year, you bought too many of them. So yeah, office supplies is going to be a current asset as well. 3,000. So what we're going to do is we should total current assets, add them up, and we get 28,500. Okay, Now we'll start out with our plant assets. We have truck of 172,000 less the accumulated depreciation, right, which is 36,000. Notice that we use the inner column, right, because we want to get our book value to bring it over to the most right column here. So 172 minus the contra asset accumulated depreciation, so we minus 36. Our book value is 136,000. Okay. Now I think we have land. I was mistaken. I thought it was just truck, but we do have land. There it is. So land is also a long-term asset. And so we'll put that underneath there. There you go. That should do it. With that in mind, I think we can go ahead and add up our total plant assets, right? And then our total assets would be the total current assets plus the total plant assets would give us the total assets of 249,500. Okay, let's go over to liabilities. Current liabilities. Looks like we got two of them. We got accounts payable and interest payable. That long-term notes payable is not going to go in the current section. So we got accounts payable and notes payable. Let's go ahead and do the first one. Accounts payable of 12,000. Next one, we have interest payable of 4,000. Okay. So what is our total current liabilities? Well, it looks like it's to be 16,000, right? All right. Now we're going to move to long-term liabilities. And okay, I only see one. There it is. Long-term notes payable, 58,000. Okay, good. So the total liabilities, which would be the current liabilities of 16 and the long-term liabilities of 58, add that together, that's 74,000. Now what we're going to do is we're going to complete the equity section. And remember, the equity section is made up of common stock and retained earnings. Well, common stock is right here, right? Common stock of 30,000. Now, this is where it gets kind of interesting, folks, because we know that we need retained earnings, right? And you're tempted just to use this number here, 140,000, right? That's not it. That's the beginning retained earnings. And so what we need to do is we need to put all these temporary accounts and put them into our retained earnings, right? So here we've got our revenue of 130,000 and then all of our expenses. And this nets out to net income. So that's why we're going to add net income to the beginning retained earnings. And then, of course, we know that the next part is the dividends, and we're going to subtract the dividends there. So this together will be any retained earnings, right? Because these are all your temporary accounts, and we just haven't closed them yet. So that's why this is retained earnings is the beginning. But if you net that all together, it's going to come out to 145,500. Okay, so all that netted together, retained earnings is going to be any retained earnings is 145,500. Okay. So we need to add up our total liabilities and then our equity accounts. So that would be 249,500, and we are in balance, right? 249,500 is assets equals our total liabilities and equity of 249,500. We are in balance, and we are happy accountants. Okay, that does it for this part. We have one more part to go, so I'll see you in the next short video. Bye-bye now.